There's a lot of lies and fake news about interest rate cuts for 2024. Welcome to hbrv Lifestyle, the podcast. I am the Honey Badger, here to give it to you straight and transparent about the RV business and in some cases the world. Jerome Powell never said that he guarantees that he will cut rates 3 times next year. There was no words of guarantee. And I'm going to prove it here by playing the full first 8.5 minutes before questions and clip art started to work with the corporate media and YouTube. Now, I forewarn you, this will probably trigger you because you've probably been waiting for rates to come down, and there is a possibility they may come down. He says it's possible. He never says it's a guarantee. The only thing Jerome Powell guaranteed was that they were not going to raise interest rates for the next 6 weeks. That's it. And I'm going to prove it here. I've got it, CNBC's version. Well, it's not version. It's just what they released on YouTube. It's 44 minutes, 39 seconds long. But I'm only going to go over the first 8 minutes because the question and answer is all hypothetical. So I don't deal in hypothetical. I deal in fact. This is a YouTube-only episode. I'm not airing this anywhere else. So congratulations to you, those of you that are fans of the YouTube channel. We are going to absolutely tear the corporate media apart and fake news. Here we go. We're going to start with his first. The first 13 seconds are probably the most important. Here we go.
Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain.
Okay, I'm going to replay that. I want to make sure everybody understands. Those first 13 seconds will tell you everything about what they're thinking about next year. Let's replay that.
Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain.
First thing he mentions is the path forward is uncertain. Folks, he is not guaranteeing that they are lowering interest rates. He says inflation is not where they want it, and there's no guaranteed path forward. Let's be real. These idiots that are real estate people, I'm an RV guy. I would love interest rates to come down because that means I can make money. You guys don't understand. When interest rates go down, I'm going to raise my prices. I'm going to have the ability to make profit again instead of hemorrhaging money. I have lost at a single location over $700,000 this year selling travel trailers, toy haulers, fifth wheels, and motorhomes. Why? Because interest rates are high. Because we can't make the money unless rates come down. So why would I want rates to be high? For those of you that, you just want rates to stay high. No, I want rates to come down. But what I don't want is I don't want a bunch of people out there going, I'm going to wait because he promised that rates are going to go down. Everybody's saying rates are going down. The Dow Jones went through the rich people control the Dow Jones. So it's all a narrative. Jerome Powell does not play a freaking narrative, man. This is, he's giving us the true assessment of where he sees the economy. Let's listen further. And pardon about my sniffles. I think I'm actually catching a cold.
As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt.
Okay, that last sentence is very important because he's going to go into it a little bit further in a few more details. But the biggest thing that Jerome Powell just said right there was that there are segments of the economy that have not felt the restrictive tightness yet. And I'm gonna spoiler alert it a little bit. It's three main factors. One of them they can't control, but two factors that are controlled by interest rates that are not being brought down is housing and energy. Gas prices still through the roof. Housing costs still through the roof. That's just an example. He didn't physically say it yet, but that's an example of those markets have not even been hit by the high interest rates yet. So let's listen further.
Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers.
Okay, that's important right there. So again, something that he's trying to control that's not getting the pressure applied properly. He's trying to tell you that unemployment needs to be higher and job creation needs to be lower before they can start easing. Okay, so they are prepared to raise interest rates in 2024 if necessary. Okay, they are prepared for monetization or monetary tightening if necessary.
FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026.
Okay, once again, a projection about the S&P 500. What the S&P people think is that the core inflation, and remember this, he said food and energy prices are excluded from this. If you got to read between the lines with Jerome Powell, because he's trying to stay neutral. He's not a politician. He's not even a personality, man. I mean, he's kind of a robot. And he's trying to process and say things. You could pay attention like, okay, I can't say that I don't want to bring interest rates down because food and energy prices are too high. What he's hoping for is he's hoping that their monetary policy drops everything down to 2% by 2026. That's the projection. That doesn't mean it's going to happen. That is the projection. Let's just remember the 1970s, okay?
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate.
They are prepared to tighten monetary policy if needed. Guys, he is telling you interest rates are gonna go up if inflation does not get under control. If it stays at 3.1, okay, they're gonna raise the rate in January. If we see that the economy is not slowing properly to be able to put pressure on prices better, they're going to raise the interest rate. They're going to tighten monetary policy, but they're not going to guarantee they're going to raise. So no matter how you look at it, there's no fucking guarantee whether they're going to raise the rate or lower the rate. There's no guarantee. We have to wait 6 weeks, see what quarter number 4 brought, before they're going to make any decisions at all. Listen to him.
We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026, still above the median longer-term rate.
Okay, it is a projection. Projection. Fucking open your ears, and YouTube idiots and the mainstream media. He said that the entire Fed Council said that if it continues down the projection they see, they will cut rates. That they are prepared to raise interest rates if it's needed. So reality is we're at the status quo. That's what is reality. Reality is that interest rates are not coming down and they're not going up until we see what the progress is on January 30th and 31st. That's when the Fed meets again. January 30th, January 31st, 2024. So guys, don't believe the bullshit. Don't believe it. Don't fucking believe any of the bullshit that all these real estate people are putting out there. Don't believe it. Don't sit there and go rush to buy a home because interest rates are dropping. Rates are dropping. Some idiot told me I got 6% mortgage yesterday. And how much did you have to pay to buy down that rate, sir? No reaction. No comment. Can you believe it? So I get told by a guy that he got a 6% interest rate on his home loan. How much did it cost you to buy it down, sir? No reaction. No reply. Guys, don't, and this is giving my final thought on this whole thing, okay? Don't believe that anything the media tells you about interest rates right now. Don't believe TikTokers, don't believe YouTubers, don't believe nobody. Listen to the man. You can go, in fact, you know what, since this is on YouTube, I'm gonna link this video in the description box below so you can listen to his full thing. They're not freaking cutting rates. They don't know what they're doing yet. It is a projection. Hell, I project I'm gonna be a millionaire in 2 years. They're projecting that we're gonna get price stability next year, and we may, and the words is may, at the end of the year, have a rate cut. I'm gonna replay it one more time for you, okay?
Based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table.
They don't want to take the possibility of raising interest rates off the table.
If the economy evolves as projected, the median participant projects that the
If the economy maintains the course it's projected,
appropriate level of the federal funds rate will be 4.6% at the end of 2024.
4.6 at the end of 2024.
3.6% at the end of 2025, and 2.9% at the end of 2026.
I rest my case. Have a great night. I know there'll be comments in there that are going to tell me I'm full of crap, but that's okay. I have 2 ears, I can listen, and I know the truth.